Want to know the best investment strategies? Today we dive into the sea of investment strategies to fish out the best ones for you. Investment strategies are not just about buying low and selling high. It's a well-thought-out plan designed to achieve your financial goals. Whether it's saving for retirement, buying a home, or funding your child's education, a sound investment strategy is pivotal. In the vast world of investing, there are numerous strategies that investors employ. Some prefer the steady approach of dollar-cost averaging, while others prefer the long-term strategy of buy and hold. For those with an appetite for high returns and high risks, growth investing might be a suitable strategy. And then there's value investing for those who love to find bargains in the market. Now let's embark on this exciting journey to financial prosperity. First on our list is a strategy called dollar-cost averaging. Dollar-cost averaging, or DCA, is a strategy where you invest a fixed amount of money into a specific asset at regular intervals, regardless of the asset's price. It's like setting a pace in a marathon. You don't sprint at the beginning and you don't slow down at the end, you just keep a steady pace all throughout. The key advantage of dollar-cost averaging is that it mitigates the risk of market volatility. In other words, it helps you avoid making poor investment decisions based on short-term price fluctuations. By investing the same amount of money over time, you buy more of the asset when prices are low and less when prices are high. Over time, this can result in a lower average cost per share, hence the name dollar-cost averaging. But like all strategies, dollar-cost averaging has its disadvantages. For one, it assumes that you have a steady cash flow to invest regularly. It also doesn't guarantee profits or protect against loss in declining markets. And if the market is on a consistent upward trend, you might miss out on some gains by not investing a lump sum at the beginning. To implement dollar-cost averaging, you need to follow 3 simple steps. First, decide how much money you want to invest. Second, choose a regular interval at which you will invest, like weekly, monthly, or quarterly. And third, stick to your plan, regardless of what the market is doing. Remember, dollar-cost averaging is about consistency and discipline. Now let's imagine you have $1,000 to invest every month. If the price of the asset you're investing in fluctuates between $50 and $100 over a year, you will buy more shares when the price is low and fewer shares when the price is high. Over the year, your average cost per share will likely be lower than the average market price. That is dollar-cost averaging, a strategy that can help mitigate the risk of market volatility. Moving on, let's talk about a classic strategy called buy and hold. This investment approach is as straightforward as it sounds. It's about purchasing stocks or other assets and holding on to them for an extended period, often years or even decades. The idea is to ride out any short-term volatility in the market and benefit from long-term growth trends. Now, why would someone choose to buy and hold? Well, the first advantage is simplicity. There's no need to constantly monitor the markets or make frequent trades. Instead, you make your investment, then sit back and let time do its work. Another benefit is cost-effectiveness. Since you're not regularly buying and selling, you're saving on transaction fees. This strategy is also tax-efficient, as long-term capital gains are usually taxed lower than short-term gains. But like all strategies, buy and hold isn't without its downsides. It requires a lot of patience, and not all investors have the stomach to weather market downturns without panic selling. And let's not forget, past performance is not indicative of future results. Just because a stock has historically performed well doesn't guarantee it will continue to do so. So how can you use this strategy effectively? Start by diversifying your portfolio. Don't put all your eggs in one basket. Invest in a mix of stocks, bonds, and other assets to spread the risk. Also, consider your risk tolerance and investment goals. If you're young and saving for retirement, you might be able to afford more risk than someone nearing retirement age. It's also important to periodically review your portfolio. While buy and hold means you're not constantly trading, it doesn't mean you should ignore your investments. Check in at least once a year to ensure your holdings still align with your goals. Remember, buy and hold is a marathon, not a sprint. It's about playing the long game and making decisions based on long-term growth potential, not short-term profits. So, if you're an investor with a long-term vision and the patience to ride out the market's ups and downs, this strategy might be for you. Buy and hold, a strategy that requires patience and a long-term vision for substantial rewards. Next up is a strategy for the ambitious investors out there: growth investing. Growth investing is a strategy that focuses on capital appreciation. It's all about investing in companies that are expected to grow at an above-average rate compared to other companies in the market. This strategy is often associated with high-risk, high-reward scenarios. It's like planting a seed and waiting for it to grow into a tree, hoping that the tree will bear fruit in abundance. The benefits of growth investing are quite compelling. First, there's the possibility of high returns. Growth stocks have the potential to outperform the market, especially over the long term. Second, growth stocks often come from dynamic sectors such as technology or healthcare, which can be exciting to follow. And third, these stocks often reinvest their earnings, which can lead to exponential growth over time. But growth investing isn't without its downsides. It comes with increased volatility and risk. These stocks can be overvalued, which means you might end up paying more than what the stock is worth. And if the company's growth doesn't live up to expectations, you could face significant losses. So how do you implement this strategy? It starts with research. Look for companies with strong historical earnings growth, solid future growth prospects, and innovative products or services. These are often indicators of a potential growth stock. Then consider the company's competitive advantage. Does it have a unique product or service? Is it a leader in its industry? These factors can help sustain its growth over the long term. Finally, don't forget to diversify. Even within the realm of growth investing, it's important to spread your investments across different sectors and companies. This can help mitigate the risks associated with this strategy. Remember, growth investing requires patience. It's about riding out the short-term volatility and focusing on the long-term potential. And that's growth investing, a strategy that can potentially yield high returns if done right. Last but not least, we present a strategy favored by one of the world's richest men, Warren Buffett: value investing. So what exactly is value investing? Picture yourself at a garage sale where you're looking for items of great quality that are selling for less than they're worth. That's the essence of value investing. But instead of garage sales, you're in the stock market. And instead of items, you're looking for stocks. Value investors seek out stocks that they believe are undervalued by the market. In other words, stocks that are selling for less than their intrinsic or true value. The intrinsic value of a stock is calculated based on the company's fundamentals, like its earnings, dividends, and sales. If the market price is less than the intrinsic value, the stock is considered undervalued, and that's when value investors swoop in to buy. Now, the advantages of value investing are clear. If you're right about the stock being undervalued, you stand to make a substantial profit when the market corrects itself and the stock price rises to reflect its true value. It's like buying a classic car at a garage sale for $100 and selling it for thousands. However, value investing is not without its risks. The market may not recognize the stock's true value for a long time, leaving your money tied up in that stock. Or worse, the stock may actually be worth the low price it's selling for because the company's fundamentals are deteriorating. So how do you execute this strategy? Well, it takes a lot of homework. You need to understand financial statements, perform ratio analysis, and have a good grasp of the industry the company operates in. You also need patience, as value investing is a long-term strategy. In essence, value investing is about finding hidden gems in the market. It's about being confident in your analysis and patient enough to wait for the market to recognize the true value of your undervalued stock. That's value investing, a strategy that seeks out undervalued stocks in the market for potential high returns. And there you have it, 4 powerful investment strategies to consider. We've traveled through the steady path of dollar cost averaging, a strategy that encourages regular investments over time, reducing the impact of market volatility. Then we ventured into the realm of buy and hold, a long-term strategy that relies on the resilience and growth of the market over time. We touched on growth investing, where the focus is on promising businesses that show high potential for expansion and profit. Last but not least, we delved into value investing, a strategy that seeks out undervalued stocks, betting on their eventual rise in value. Each of these strategies comes with its own set of benefits and risks, and their effectiveness can vary based on market conditions and individual financial goals. Remember, the best investment strategy is one that aligns with your financial goals and risk tolerance. Thank you for joining us, and until next time, happy investing.